Hey everybody, this is Dr. Tom Carr, aka Dr. Stoxx of drstocks.com. That's DRSTOXX.com of drstocks.com. We've been in business every market day since October of 2002. This is coming to you live from the live trading room. And if you'd like to join me, the live options room, we have two live rooms: live trading room where we do stocks and ETFs and micro e-minis, and the options room where we do options. And if you're interested in joining one or both, click on the subscribe button, go down to the live options room. You can add on the live trading room at a discount if you would like to join both. All right, so this Friday, today is Wednesday, the 11th of June. On Friday, the 13th, I will be a guest on the IBD live show. And it's a 2 hour live show starting at 9 o'clock Eastern time, going to about 11:15. And we go over a market, everything that's going on in the market. And I share with the audience stocks that I'm interested in, stocks that I'm already in, stocks that I think have really good upside from here. And we'll go over those charts and some of the reasons why I think they have a good forward look going into the rest of the year. And that will all happen on Friday at 9 o'clock in the morning. If you're interested in joining us, you can go to, let me, oh boy, hold on a minute here. If you're interested in joining us, go to investors.com and come on, guys. There it is. And click on the IBD Live button, and then you can join the IBD Live group. That's the only way you're going to see the Friday show, by clicking on the shopping cart page, and you can you get a special offer there. 3 months for $9.95. You can cancel at any time. I'm not exactly sure what the regular rate is, but it's not that expensive. But you will need to be a member in order to see the live show. And IBD Live is on every day. So Friday's just the time they bring in a guest, and the rest of the days, the in-house Investors Business Daily market analysts are talking about stocks and the market and macro events and all kinds of good stuff. So if you want to keep abreast of the IBD's view of the market, and I recommend it because they're very good. They're very, very good, very conservative, and very well-tested methodology that they use, and you'll get a lot of good information out of that. Okay, so here's what I'm going to be talking about. Let me first get a chart down here. This is the Market Surge screening tool software that I use. It's an Investors Business Daily product. It has all of the Investors Business Daily proprietary metrics for both fundamental and technical strength in stocks. And I have set up a number of screens that I use to find the best stocks to trade in the market. And I'm going to be sharing some of those stocks with our audience on Friday, this IBD Live service. So here's what I'm going to do. I'm going to talk a little bit about how we're really in two different markets right now. You've got a whole set of stocks that have kind of bypassed the whole tariff fear thing that the market was discounting so sharply at the end of March, beginning of April, and for a few weeks along the way. They've just kind of forgotten all about that, and they're trading up near 52-week highs, in some cases all-time highs, with still a lot of great growth potential going forward. So I'm going to share a few of those. And then there's the other market, the other side of the market, which is stocks that are not doing so well. They got whacked on the tariff fear, but they're also pricing in some of their own unique concerns. About half of the S&P 500 is trading under the 200 period moving average, and you've got some negative returns in some very key sectors of the economy, like real estate, consumer cyclicals, energy stocks are low, healthcare stocks are down. And it's in those sectors, at least some of those sectors, that we can find some really good value plays. So, two different markets: very strong market, not worried about tariffs at all. Rather weak market, still concerned about tariffs, still pricing in some things that, the higher interest rates and fear of inflation, and the immigration policies that are curtailing some of the lower costs of labor. So those are actually, I was going to mention this, the three big macros that the market is concerned with: tariffs, inflation, and falling higher labor costs because of the immigration policies. Um, Guess what? There are two things that those three things have in common. Number one, Trump is the first cause of all three of those things, and number two, none of those fears have materialized at all. Now, tariffs are still kind of being worked out. That still could be a problem for the market, but we really haven't seen the disruption of supply chains, the incredibly high inflation on prices. We're not seeing empty shelves. The consumer is still doing fine. The consumer sentiment is still strong. Our Walmarts are all fully stocked. There's not a big pile of ships out there off of Long Beach. So yeah, that fear is not materialized, at least not yet. That still could be on the horizon. Inflation, we just saw this morning, CPI came in tame. We've got PPI tomorrow that will probably also be tame. So we're not worried about inflation, consumer inflation, not at all. And thirdly, the cost of labor. Well, we're seeing no weakness in the labor market. Unemployment rate is still nice and steady, and labor costs are still also steady. So, three big fears the market's been pricing in, but they haven't materialized yet, and that typically spells continuation of a bullish market. That's where we are, and I think we'll probably be there for most of the summer. Probably get a little bit of a hiccup in September as we usually do, and then a nice Santa rally to close out the year. That's kind of where we're heading. Of course, all that can change in a heartbeat with a tweet of one sort or another. But anyway, it is what it is, and it's just the market that we have. We have to trade that. All right, so I'm going to share with you a few stocks that I'm seeing that are doing pretty well. And I've got, again, as I said, two sets of stocks that are trading up near 52-week highs, all-time highs that are strong and should continue to be strong. And then stocks that are lower than that, 20, 30% underneath their 52-week highs and maybe well off the all-time highs. And I apologize for the noise in the background. We've got our landscapers here today, so there's some stuff going on outside. All right, here's a strong stock number one. Now, this one is actually one of my favorite stocks in the market. It's been in the IBD top 10. It's been on the leaderboard, IBD leaderboard. It is a frequent top stock in my A-list scanner in Market Surge. And so I know that this is a strong one. And it's an interesting company. If you were trading with me back in was it the 80s I wasn't really trading in the 80s, but the 90s I started to trade. And in the 90s and 2000s, there was a company called Taser. The stock ticker symbol was TASR. And they invented this non-lethal weapon that could be used by law enforcement to stop criminals in their tracks without doing any permanent damage to them. And that was, that's a good thing, really good thing. So they manufactured it, they promoted it, they had a patent on it, and their stock just took off like crazy. Well, to make a long story short, they ended up almost going bankrupt, and there was competition coming in, and there were very similar kinds of products, and so on and so on. Anyway, that company revitalized itself. It changed its name, it changed its brand, it changed the way it does business, their business model. They brought in a new CEO and all kinds of good stuff. And today they're known as Axon Enterprise. They still make the Taser, but here's the thing that they've done. They've kind of ramped up their AI profile. And if you remember, the old, not that old actually, but there was a sector in the economy that was a very strong growing sector called the Internet of Things. There were companies who were specializing in connecting smart phones and smart tablets and smart this and smart that within households, within cities, within countries. And the networking of all that information was a big driving force in the economy, in the tech economy. And Axon is kind of in that space, but it's not the Internet of Things. It is the AI of things. So here's the thing: they make tasers, they make body cams for police force and law enforcement officers. They make dash cams, and they have several drone companies. They're a drone maker They have drone. They have a big drone tech. The number one company in the world for drone technology is owned by Axon Enterprises, um, and they have this platform, this networking platform that connects all of those things, so that a person out in the field, a law enforcement officer, a person out in the field, would have like up to the instant absolute tracking of everything that's in their environment, right? Where are the bad guys? Where are the good guys, the innocents? And what's going on all around them because of all that information that's being crunched. And they get instant feedback. They know it's just makes their job a lot easier, makes it a lot safer. That's Axon Enterprises. They're responsible for all of that. They have contracts with 90% of the police force in the United States, and they're starting to write contracts now for British police force. So, Axon Enterprise. Here's their chart. You can see that it hit new all-time highs back here in May, right? As the rest of the market, the economy is worried about tariffs and inflation. They're just popping to new highs all the time. We had a little bit of a pullback to the rising 20-period moving average on Tuesday of this week, reversing right back up again today. This is a good stock to hang on to for the long haul. Here's some other interesting things about Axon. They have the highest compound annual growth rate of the 70 top stocks in the S&P 500. Take the 70 top stocks in the S&P 500, and they're number one in terms of CAGR, right? CAGR. I mentioned the drone service that they have, the 90% of contracts with the police force. I'm not sure if this is a good thing, but their CEO, Rick Smith, his name, he is the number one highest paid CEO in the world right now. He makes 3 times what Jensen makes over at NVIDIA. Not even close, right? He's way up there. Now, he's being paid in stock options. So he has a very vested interest in seeing this company do really, really well. So that is also a big incentive. All right. So here's the chart. You can see that it did break out above 716 a few weeks ago. It's been a nice, slow, steady uptrend. This is a buy the dip stock. Anytime there is a dip of even a couple of days, you want to get on board. I would also say that if you bought right here and held for 4 or 5 months, you're going to be looking at a 4-digit stock pretty quickly. Okay, that's Axon. Let me show you now a second stock that hang on a sec. A second stock that would be in that second category, the category that is a little bit behind on ramping up to 52-week highs, but it's a very familiar stock, and it is starting to do some really good things. AMD. Now, just as a disclaimer, we do own AMD shares in the live trading room. I have some in my own family of fund. AMD is really an underdog story. So, Malcolm Gladwell, who is a best-selling author of books on megatrends in culture, he says that being an underdog creates opportunities that the top dogs never get. And I think that's very true for AMD. 2014, the company was almost bankrupt. Their stock was trading under $2 a share, if you can imagine that. 2014, 11 years ago. They had $2 billion in debt, and they were in this, this war, this battle of the CPU, GPU, Intel chip. They were battling Intel, and they were losing. Right? Intel had the big brand name, had the fastest chips, the most stable, and everybody was looking at AMD as like a cheaper rival, but not as good. Then in 2015, a new CEO was hired. Her name is Lisa Su. She has a PhD in engineering from MIT, right? I think that's exactly what the AMD needed. They needed an engineer to come in and revitalize that company, and she did. That's exactly what she did. First of all, she started hiring the best chip designers that were willing to work for cheap. The best ones they could have at the lowest a salary level. So that was pretty smart, right? You get the guys that really are thinking creatively and outside of the box, and they know what they're doing, but maybe they're from other countries that don't have as high a standard of living, and so you can save some money that way. They started buying companies. I know they were in debt, but once they started getting some some better capex, they started buying companies. They bought 8 companies in the last 3 years. Today, AMD is the second most um, uh, best performing stock in the entire market, second only to Nvidia. Right, over the last 10 years, I need to qualify that. Over the last 10 years, AMD is number two. It has returned 5,000%. And as you can see from this chart, it's nowhere near its all-time high. So lots of good upside here. Um, the trailing PE of AMD is a little bit expensive. So, I mean, if you're comparing it to Intel, it's expensive. If you're comparing it to NVIDIA, not so expensive. It's kind of in the middle of that. But here's the thing: the PEG, right? The PE to growth ratio. If you look at that as a way of marking the valuation of this company, it is super low. It's one of the lowest in the whole space, right? For the big players, it's one of the lowest in the whole space. 0.6 PE ratio to growth. Why? The PE ratio is a little bit high, but the growth is off the charts, absolutely off the charts. Okay, so they have a new chip that's out. It's driving 33% of the revenue. The projection is that it will soon be 50% of the revenue. That's a big upside. The free cash flow is has increased 92% over the last year. That's massive. They're in the midst of a $10 billion share buyback program. An insider who's never bought shares in his career there just a few weeks ago bought $1 million of AMD stock. Amazon owns 800,000 shares of AMD. I didn't know that until I started digging around. That's a good backup. That's a good backstop right there. Now, August, 2,200 calls. The stock is trading at $120 right now. Someone plowed into August 200 calls in big size. I don't have a number of the size, but it was way, way above open interest. Somebody with deep pockets is very interested in seeing AMD get from where it is now, 120, all the way up here by August. I don't know what's going to happen, but that's a big move. Okay, so the chart. Here's the interesting thing about the chart is that you've got this beautiful looking head and shoulders. You're going to see this in a lot of tech names. You're going to see it, in fact, all over the market, in banks, in software. Left shoulder, deep head, right shoulder, and hasn't broken out yet. It's got to get above the 200 period moving average. It's one of those stocks that's below it. It's having a little bit of trouble today, probably with other factors going on in the market. But once that does break out, you're going to see a nice move. The depth of the head is let's just round it off here, 75 to, let's say, 120. That is a 45 handle depth. You add that to 120, and you've got 165 up here as your target. Not a bad move from 120 to 165. Okay, so that's AMD. Now, let me do 2 more stocks, and then I'm really going to have to let you guys go. Real quick, a biotech stock, EXEL, the number 1 rated biotech stock. And I have to qualify this. You've got biotech stocks that are listed as biotechs, but they're really more kind of established drug makers, don't really have much of a pipeline. And then you've got the speculative biotechs that don't have any drugs that they're selling right now, but they've got a really interesting pipeline. And Excel is kind of in between. It has 2 big blockbuster drugs, 1 huge blockbuster drug, and then it also has a good, healthy pipeline. I think there's 6 drugs in their pipeline right now, and several of them, 3 of them, I think, are in phase 3 trials. Okay, so here's some things. They're in the cancer space. The 2 big blockbuster drugs are in the kidney cancer space. I'm sorry, they have 4 drugs in phase 3 trials and 6 in addition to that already in the pipeline. They have a strong cash position. They have a low PE ratio, which is unusual for a med tech, biotech type play. In fact, their PE ratio is 70% lower than the S&P itself. Can you imagine that? 70% lower than the entire S&P 500. Their earnings have rallied 250% year on year and 350% in the last quarter. for quarter on quarter, and a 48% upside surprise was announced at the last earnings report. Carbometrics is their main product, and here's the thing: in March, you're going to see this somewhere in the chart. Um, I'm not sure. I guess it was announced. No, it was announced at the May earnings report. The FDA has just qualified their Carbometrics, which is kidney cancer drug, for other kinds of cancers. There's a term for that in the biotech world. And I'm kind of forgetting what it is, but when the FDA gives you clearance, not only for what you're using it for now, but for other conditions, that's a big deal, right? That's a big deal for a stock, and that's why not only was it the upside surprise, but it was that FDA announcement that gave us that big power gap to new all-time highs, even when the market is worried about tariffs, right? Tariffs and inflation. Okay, pancreatic cancer. That's it. Not just kidney cancer, but pancreatic cancer, which is a pretty common form of cancer these days, sadly. There are four growth vectors for this company. It still has a lot of room to upside in international sales. It has licensing revenue from its drugs that are being sold in other forms. It has collaborations with some other big names in the industry, and it has the strong pipeline, as I mentioned. It's been a bit out of favor with the analysts. You know, they're all kind of on modest buys, kind of buys, holds. Uh, they're reiterating, they're not upgrading. But that's actually a positive because if Excel keeps continuing higher, it's lower today, I have to say. It looks a little scary today. But if it keeps continuing higher, those analysts will have to start upgrading soon. The number of big funds invested in Excel went from 815 to 924 in 1 year. That's a good upside. All right, so here's the chart. It broke out on the power gap on earnings. It pivoted all the way up to 48.85. It has pulled back into the rising 20 period moving average. We went long right there, and it hasn't done much for us since then. So it's now starting to break a little bit below. This might be the one that stopped me out. I had to stop out just a little bit ago. But it is below now. It's below that range. So I would say, looking at the chart today, it's not a buy right now. Let the market kind of sort itself out. It will probably pause and reverse somewhere between the 50 and the 20. You want to make sure that this earnings gap stays open, however. So the bottom of that gap is around 40.40. You don't really want to see it get that low. If it starts dipping out down into that gap, then the market is saying, hey, it's not worth $48 per share. It's something under that. So we don't want to see that earnings gap close up. It should hold. So 40.40 is probably a good line in the sand. And if it holds and bounces from there, that would be a nice entry. All right. The last thing I'll just mention real quickly, this is a beaten down gem, but I have to say, after the last couple of days, it's not that beaten down anymore. Micron. Micron is just off to the races. So I was doing this research over the weekend, and here's Wednesday, Tuesday, Monday. The weekend is right about here, and the stock was in the low 100s, and now it's up, what, 115? So it's rallied a good 10% over the last several sessions. But that said, it is still a good 20% or so below 52-week and all-time highs. I'm going to have to figure out exactly why the market is so excited about it right now, but there must be something good in the news cycle, and it's holding up very well today when a lot of other stocks are falling pretty hard on the whole China deal thing, which doesn't seem to be quite as exciting as we thought it was in the pre-market. So Micron, what's going on with this? This is a 50-year-old company. It does storage and memory for applications, and it at the time I did this was 30% under their 52-week high. Now it's more like 20%. They do memory storage for enterprise, mobile, networking, and cloud applications. They're a leader in high bandwidth memory, which is critical in all AI stuff. Anything with AI needs high bandwidth memory. They are the supplier of NVIDIA's Grace Blackwell super chip, and they also have partnerships with Google and AMD. They have a 50% bigger memory storage and 20% more energy efficient than their nearest competitor. And they already sold out of their 2025 supply. All gone. They've already sold everything all their product in 2025. So they're ramping up capex to meet what they call a multi-year demand inflection. What does that mean? It means that, and that's probably why they're soaring this week. That means there's a lot more demand than they thought, right? They have to ramp up production. They're borrowing money now to do that. And that's always a good sign, right? Always a good sign. They have over $4 per share in income. It's projected to be over $11 next year. That's a very big upside, and the market has not priced that in yet. Shares trade at just 26 times trailing earnings, 10 times forward earnings. They have low debt and 167 average year-on-year earnings growth. The chart was a inverted head and shoulders breakout right around 100, and it's now 15 points higher than that. So the depth is about 40 points. So 140 would be your target, and it's still some really good upside there. All right, guys, I'm going to have to let you go. I will produce this video. I'll stick a link in the room a little bit later today, but I'm going to jump over to the live trading room and do the same thing over there. God bless everybody. See you in a little bit. Bye for now.